the lectures up on Canvas, okay? And the way you find most of the information for this class, don't forget, is to go to modules. And when you're in modules, there's that practice midterm module now that I've put at the top. As you can see, there's one there now, and I'll probably put another one in time for Monday's class, so we can, you can work with this one, and we can maybe get through both of those prior to our test on Wednesday. There's the solutions, by the way, to all of the homework questions in the wild text. And then what's happening is I'm going ahead and I'm posting up the video of the lectures after we go through them. Okay, for example, last time we started Chapter 3 lecture, and so you can see the video for Chapter 3 lectures right there. And then what I'll probably do is go ahead and put, finish of Chapter 3 and Chapter 3 quiz underneath here. And so you can always see the file that we looked at and the video of the lecture there. Okay? So that's where the information is, just in case you're still trying to find everything on Canvas. And so what I'm going to do is go ahead and now, of course, now that I put it in tablet mode, and I don't have my mouse with me today, let's see if I can figure this out. And my recollection was that we were right about here when we left. We had just finished talking about accruing expenses. We had talked about unearned revenue, and we were just about getting to the time when we would discuss how to accrue interest on a note. When a company borrows money, okay, when we borrow money, we're going to obviously have to pay interest on that money. And so in this example, they were having a situation where we were trying to accrue 1 month's worth of interest. Okay, now the way that is done mechanically in the calculation is the way you see right here. I'm just going to go ahead and rewrite it, but it's pretty much written there the way you need to do that, which would be to take the face of the note, $5,000, and since they're telling us, by the way, this would be an extraordinarily high interest rate. If someone tries to charge you 12% interest these days, tell them to jump in the lake, because that's too much. 5,000 times 0.12, and since we were only borrowing that money for what? For 1 month, we would multiply that times 1/12, and that's how they got this $50. And that means that we borrowed money for 1 month, and so for that 1 month, we incurred interest of $50. Now, we're not going to pay the person at the end of the month. Maybe we're going to pay them off this whole note. It's a 3-month note, so maybe we're going to pay the entire amount we borrow the money October 1st. We hold the money October 1st, November, all of October, all of November, all of December. Maybe we're going to pay them back January 1st is when we'll finally pay them back both the principal and the interest. But you can see that for that first month, we'll go ahead, we'll debit interest expense for $50 and credit interest payable for $50. And we do that October 31st. Now what happens? Do we accrue another month of interest? How long was this note? How long is this note? 3 months. Do we accrue another month of interest in November? Yes. So what's going to happen? 11/30, what journal entry will we make? Same journal entry. It'll be another months of interest. We'll debit interest expense, $50. We'll credit interest payable. Okay? So let's just go ahead and tee up interest expense up here. If this is our interest expense, so far we've done October and we've done November, so far that's $50 for October, $50 for November, isn't it? Right? So far we've got $100. And if we're looking at our interest payable is going to have what? Just tee that up here. Interest payable is going to be $50 here for October. Oops, but it's a payable, right? So it's a credit. $50 here for October, and $50 here for November, right? Okay, what are we going to do on December 31st? Same journal entry again. 1 month of interest has gone by, and we're going to sit there and we're going to do what? $50 for the interest payable, $50 now for the interest expense for November, right? Right? So our interest expense for the 3 months ending December 31st is $150. Our interest payable is $150, isn't it? Okay. Now, I could give you this same question on your midterm, and I would ask you maybe what is the amount of interest pay if they're going to pay the note back on January 1st? What is the amount of interest payable at December 31st? How would you calculate that? I know it's $150, but do you want to sit there and do it a month at a time on the exam? How long are we going to have for our exam? A little over an hour? Huh? Now you're going to, good. Now you're going to go ahead, take the 5,000, right? Multiply that by what? Our interest rate is still 0.12 times what? Times not 1/12 now, but what? 3/12. Will you still get 150? You get 150 that way? Okay, and then the journal entry would be to do what? That would be, of course, at 12/31, would be to debit interest expense for 150, credit interest payable for 150, right? Right? Okay, let me ask you this. Where's your calculator? Where's the calculator? You guys, when you come to accounting class, you should be like, you know, you ever see the cowboys on TV when they go to pull their gun out? Okay, you should be like that when I say calculator. Do you have your calculators, guys? Calculators, please. It's like this. It's like a musical instrument. Where's the calculator? Okay. All right. Everybody got the calculator? Guys, I'm speaking to you too. Do you have your calculator? Okay. Go ahead and put your calculator there. Put this $5,000 in there. 5,000. And put times 0.12 and hit equals. You get that number? Then say times 3 and hit equal. And then hit divide by 12. Divide by 12 and hit equal. Do you get 150? Good. That's how you do it on the test. Trust me, if you try to get fancy with putting the numbers in there, the computer's going to say, the calculator's going to say, you are doing something wrong, or it's going to give you some weird number, and you're going to say, okay, that seems right to me. Why can't I get any of the choices? And you're going to come to me and say, did you make a typo on this question? And all that kind of stuff. You do it like that, otherwise the computer gets confused about the order of operations, right? So that equal sign in between is sort of like a clear, but it does what? It holds that next number in there, right? Okay. Question on how to do this? Principal times the interest rate times the number of months this note was outstanding, right? If it's an annual interest rate, why does it multiply by 12% every month? Because we adjust for that by saying 1/12, 2/12, 3/12. So that's why I did it where we did it 1 month at a time. We got $50. If I didn't do the 1/12, 2/12, 3/12 for however many months was involved, I would get what? 0.12 times 5,000. What's that? 600. And 600 times the 12 months. $50, I should say, times the 12 months is 600, right? So when you just multiply it by 0.12, that gives you 1 year's worth of interest. That's the annual interest. But if we're only doing a portion of the year, 1 month, 2 months, it's 1 month, it's times 1/12. It's 2 months, it's times 2/12. In this example, it was time 3/12, so we multiplied it times 3/12, right? Okay? Yes, sir. 5,000 times 12% divided by 12 would give you 1 month. Yeah. I think it's faster to do it my way, but if you feel faster doing it your way.
No, that's what I'm saying. Your way is the fastest way to do it.
Yeah, I mean, I didn't have you do it. Kind of be ridiculous to multiply it by 1, hit equals, and divide by 12. You know, so yeah, you could skip the multiplying by 1 if it's only 1 month, right? But once you get more than 1 month, I like to do that just because it keeps me in front of me of everything that I'm doing, and I don't have. Because for me, every calculator's got a different idea of the way these things should be being done, and you get some that start flashing at you if you don't do it this way, and so this is the way I do them to avoid any confusion on my part. Okay? Question? Okay, good. Let's go ahead then, and let's take a look at salaries. Okay? So, oh, I forgot to tell you, because the burning question should be here, what about when we pay this guy back, right? Don't we have to pay him back? Right? We're paying him in January. We still got to pay him back, don't we? So what are we going to do in January when we pay the guy? How much do we have to pay him for the interest anyway? How much interest do we owe the guy? In January, we were saying we're going to have to pay the dude $150, aren't we? Okay. So what journal entry do we want to make in January when we pay him? Are we going to have to pay him cash? Or is he just going to take gold from our teeth? We got to pay him cash, don't we? So if we're going to pay cash, are we going to debit cash or credit cash? We got to credit the cash. Good. For what? $150? Okay, what do you want to debit? Good. Debit the interest payable because we're paying him now, aren't we? Right, because we're paying the guy now? Correct. So we're going to go ahead and debit the interest payable, credit the cash? Because we're paying him? Anything else we have to pay him? Anything else we owe him at this point? Huh? Yeah, we got to pay the guy his money back, right? I mean, that'd be a really sweet deal if all he made me do is pay interest and I could keep the cash, right? I got to pay him the interest and I got to pay him his cash back, right? So the full journal entries here would be what, if we're considering 1231, would be now to go ahead and debit the note payable, not 1231, but January 1st. Debit the note payable for the full 5,000 and credit the cash, right? Right? So not only do we have to pay him the interest, we also got to pay him what? Pay him back his principal. Right? Yeah. 2 slides. The slide that tells you how you increase assets, how you decrease assets, how you increase liabilities, how you decrease liabilities, how you increase revenue, how you decrease revenue, how you increase expenses, how you decrease expenses, and the chart of accounts slide that tells you whether something's an asset or something is a liability, or which account is a revenue, which account is an expense account. If you don't know those 2 slides, there is no hope for you. There's nothing I can do to bring you over to the promised land if you don't have those 2 slides. So you got to get those 2 slides down. The chart of accounts, the one that shows you which accounts are cash, are assets, which ones are liabilities, which ones are revenues, which ones are expenses. It's in chapter 2. It's a chart of accounts.
The slide right after.
Huh?
The slide right after.
I don't know if they're right back to back, but before we get out of here, I'll show you where the slide is again. Okay, you got to know those 2 slides. You got to know whether you're dealing with an asset or liability, and you got to know how to increase it, decrease it with debits and credits. If you get that down, you can bludgeon your way through almost any problem. Yes, sir. It is going to be chapters 1 through 3. Yes, sir. Not chapter 4. is why I'm saying that. Because I think last time I stuttered and I said chapter 4. I misspoke and I said chapter 4. It's chapters what? 1 through 3. All we're doing in chapters 1 through 3, guys, is getting the basics down. This is how you debit, this is how you credit, this is how you close the accounts, this is how they turn into a set of financial statements. Okay? Okay, good. Let's go ahead then and let's take a look at this question. And here we've got a situation where we have to accrue salaries if we are paying our salaries after the last day of the month. Okay? So these people pay their salaries on Fridays, and they pay their salaries on Friday, October 26th, and the next payday will be Friday, November 2nd. Now, the month ends, obviously, on October 31st, okay? And, you know, if you had a calendar in front of you, this might make a little more sense, in that we don't worry about the weekend, okay? And so we have to just deal with what? We have to deal with Monday, Tuesday, and Wednesday is the 31st in this example. So we have 3 days, year ended on Wednesday, October 31st. Okay, the way this is working. So since the year ended on Wednesday, October 31st, that means our employees worked what? 3 days, but we're not going to pay them until what? Friday, November 2nd. So November 1st will go by, November 2nd will go by, and then we'll pay them for the full 5 days, right? Okay? So what happens? At October 31st, though, since we have a month end, and we're assuming here that we're preparing a month end set of financial statements, we have to accrue the salary for those 3 days that they worked in the month of October, and then we're going to pay them for the full 5 days on Friday, November 2nd, right? So since they worked 3 days, we take that 400 times the 3 days that they worked. They worked Monday, Tuesday, Wednesday, right? 3 days. Wednesday was the 31st. And we debit salary expense for those 3 days and credit salaries payable, because indeed we are going to pay them, although it's only going to be in a couple days that we're going to pay them. At December 30, I mean, it's not December 31st, at October 31st, we did owe them what? $1,200, didn't we? So we go ahead and debit the expense, we credit the payable, and then what happens? Then on November 2nd, we go ahead and we pay the employees now for the full 5 days, right? $2,000, 5 days times how much do we pay them a day? Times 400, that's now Monday through Friday, isn't it? The full 4 days we pay them. Then what? We debit the salaries payable now, because we're reducing that liability because we paid those people off for their salary. That's for those 3 days. And then we have salary expense for November. That's the 2 days in November, the 1st and the 2nd at $400 a day. That is an expense of November. It was not expense in December, in October, because what? October was October, and this is November now, right? And we clicked into the next month. Question? Okay. All right, good. Okay, we talked about depreciation last time, so I'm not going to get into this level of discussion for depreciation. We will do it when we get into the chapters and later on in the book that deal with depreciation. I used to do it here, but we kind of riffed off on our little example of depreciation last time where we had some equipment that was lasting 4 years or something like that, remember? Okay, so we're kind of done with depreciation. Any questions about any of those things from chapter 3 now? Okay, good. So what we're going to do is, I guess I don't need to keep that. Go over and look at chapter 3's quiz. Okay. Okay. All right, so this is the chapter 3 quiz, and again, I showed you where that is up on Canvas. If you have your computer and you want to go ahead and pull that out, you can. okay? And so we're looking at adjusting entries, okay? And they tell us that on June 1st, the supplies account was $5,200, and supplies purchased during June were $3,500. So what's happening? We're sitting here. We have our supplies account. And they tell us that the supplies account had a balance of how much? $5,200. And that's at 6/1. It was that amount, right? 5,200. Okay. Okay. Good. Then what? Then they say during the month, supplies were purchased of $3,500. So if I purchase supplies at $3,500, supplies an asset? Supplies an asset? Yes, it is. So I'm going to debit supplies. $5,200. That's a debit to supplies for $5,200. And I'm going to credit, how about accounts payable? It doesn't really matter for this problem. $5,200. Okay, and when I debit the supplies, not $5,200, but what did they tell me, $3,500? Sorry, $3,500. I already had $5,200 to start the year. I debit supplies $3,500. I credit the accounts payable $3,500. And I go ahead and I debit the supplies $3,500, not $52. I already had $52. And so when I do that, the balance in the supplies account comes up to what now? Calculators, huh? $8,700, right? Don't forget, guys, by Wednesday, I'm pretty much standing off to the side, and you're going to be coming up here and doing this, right? Okay, so that's $8,700. And now what? They tell me that I count up at the end of the year, the end of the month here, and they tell me how much are still on hand? 3,000 are still on hand. Now sometimes people ask me, what's on hand mean? Is this pen on my hand? So I have it, don't I? It's on my hand. I have it now. Put it on my hand. I know we say in my hand, but think of it. Put it on my hand so that I have it, right? Okay, so it's on hand. Somebody asked me what on hand is the other day, so I'm just explaining. That it means we still have it, right? Okay? And so what happens? That means that I had, what, 8,700 apples, and I did what? I must have eaten, when I counted up and I only had 3,000 left, so I must have eaten, what, 5,700 apples? If I have 8,700 and I count that are still on hand 3,700, that means I ate what? 3,000, that means I ate 5,700, didn't I? Okay, so what do? Since it's an asset, I want to reduce it. I credit supplies, don't I? For what, 5,700? And I have to debit something. I debit supplies expense for 5,700 because those supplies have what? Have expired. Those supplies are gone, aren't they? They've expired. I want to increase an expense account. I debit the expense. I debit supplies expense, 5,700. So when I put that credit over here, when I post the credit, 5,700, does this thing come down to 3,000 where I want it to be? Okay. Okay, good. So the answer here must be what? That the amount used for the appropriate adjusting entry, which is this 5,700, right? Posting the appropriate adjusting entry, not that one, but what, this one, is to sit there and debit the supplies expense 5,700 and credit the supplies 5,700, right? Hello? Okay. This is right out of that example that I sat there at my house talking to myself, going through with you at one point, and we also sat here a couple times and went through that one example with that one spreadsheet. Same sort of thing happened in there. Remember, we had the supplies. In fact, we did it with the lemons too. The guy said, hey, you know, go ahead and take the supplies, and then we counted them up later. Oh, I don't know if we did that with the lemon one, but we did it with what? We did it with that in-class example, the 2 years, when we bought some supplies. We counted them up. I think we bought 24,000, and then we counted at the end of the year, and there was like 13,000 left or something, and so we debited supplies expense 11,000, and we credited the supplies 11,000. Isn't this the same exact thing? Okay, the only difference here is we had a beginning balance there, we didn't. Okay, so if you're still sitting there and saying, I'm not getting any of this stuff, go back and look at that in-class example, the video, that it goes through all these type of transactions as well as those slides that we just looked at. Okay, good. So we have now this Meat Puppets purchased equipment for $7,200 on December 1st. It is estimated that the annual depreciation will be $1,800. Now look, the only thing that makes this question halfway interesting is that if the annual depreciation is $1,800 and they're asking me what? Bought equipment on December 1st, and they're asking me what is the depreciation expense at December 31st, how many months is that? That's 1 month, so I take the $1,800 and I divide it by what? 12, that's what, $150 a month? Okay. And we went through last time that when you take your depreciation, you debit depreciation expense and you credit the accumulated depreciation, and that accumulated depreciation will accumulate year after year, month after month after month, and I went through the 3-year example last time, right? Whatever it was, 3 or 4 years. Remember, and then later on we sold the equipment, etc. Okay. Okay, good. Let's take a look at this one, this REM company. And I think they named all these questions after rock bands. I did not do this. And this was from the test bank, and somebody got cute and started naming some of these after rock bands. Meat Puppets is a rock band. REM is a rock band. Okay, so we have this REM Real Estate, and they received a check of $27,000 on July 1st, which represents 6 months advance payment of rent on a building it rents to a client. Unearned rent revenue was credited for the full $27,000, and now we're going to go ahead and issue our financial statements 1 month later, July 31st. Okay, so they've got this money, they debited cash for $27,000, and they credited what? What do I credit when I get money in advance of having earned it? Credit unearned? No. Receivable is what I debit when I provided I debit that when I provided a service, and I'm going to get the money later. Here, I've gotten the money in advance, and what? I haven't earned it yet, so that's an unearned revenue of $2,700, right? Just trying to squeeze that credit in there somewhere. Credit unearned revenue $2,700. Let me write that somewhere else. Debit cash $27,000. Credit unearned revenue, right? $2,700, just like $27,000. Just like, remember, the guy came and said, "Hey, I want you to be at my shows," or whatever, and he gave us the cash. We credited the unearned, right? And he said if we didn't show up, he's going to send his boys after us. So this is a liability, isn't it? We owe them money back. So we have now unearned revenue, and 1 month has gone by. So it's $27,000 divided by how many months? It's a 6-month deal. If I divide that by 6, that brings me $4,500 a month, doesn't it? Okay. So after 1 month, have I earned any of that revenue? After 1 month, I've earned 1 month of it, right? So I'm going to go ahead and debit the unearned for $4,500 and credit what? Revenue for $4,500, right? Which is that journal entry right there. All right. What will I do August 30th? First or whatever. What journal entry will I make August 31st? Same entry. What entry will I make September 30th? Same entry, right? And I'll keep going like that. Okay. Okay, good. We say the correct adjusting entry for a prepaid expense as it expires. And look, we've already done this with the supplies is really a prepaid expense, but let's say it was prepaid rent. I don't care. We paid, oh, we did that. Didn't I have the apartment in Santana Row? We had the apartment in Santana Row, and you were going to go ahead and give me $1,200 cash up front, weren't you? Okay. And that would cover you for the whole year. So what's going to happen? You're going to have prepaid rent of $1,200 when you pay me, right? Do you have a future economic benefit? You got your rent, you bet. Them parties at Santana Row, I expect an invitation to at least one of them, right? All that fun you're going to be having over there because you paid $1,200 for the whole month's rent, right? In a nice spot. Okay, so then what happens? So then the first month goes by, doesn't it? And so you're going to take the $1,200 divide it by 12. That's $100 a month, right? That's $100 a month. That's a dollar sign. That's $100 a month. 100 a month. Okay, and so for that first month, you would debit rent expense 100 and credit what? Credit the prepaid because you've expired a month of that, haven't you? Right? Prepaid rent would get credited. Is that the journal entry they're giving me right here? Debit expense and credit the asset, prepaid rent. Prepaid rent is an asset, right? Okay. Okay, good. Now, what's the balance in the prepaid rent account? In the prepaid, after 1 month, it was $1,200, right? After I made that entry, it was $1,200 when I first put the money down for that Santana Row apartment, and now what? Now I've debited $100, haven't I? So the balance is $1,100, which is telling the world, hey, there's still 11 months to go, $100 a month. I mean, they may not know the terms here, but at least they know I got some months to go, right? On this, don't you love accounting? Set you up any point in time. You can sit there and say, hey, this is what I have left. Okay? You may not love it yet. You will, though. One day it'll just click for you. I work for a course that we prepare people for the CPA exam. They try to put clever things on Facebook, and they have pictures of people looking over the side of a mountain. And I'm always like, is a person going to jump, or are they excited about the future? But the one that I want them to put was on Valentine's Day. Do you remember when you fell in love with accounting? Okay, but they didn't want to put that. Okay, so what happens? We sit here and we say, where's the proper adjusting entry at June 30th, the end of the fiscal year, on prepaid insurance account balance before adjustment. 18,500 and unexpired amounts per policy analysis of 6,000. So they're sitting there and they're telling us with language like that the prepaid insurance is showing a balance of 18,500. So I guess at some point, maybe at the beginning of this month, they must have debited the prepaid insurance for not 1,800, but what, 18,500? And credited cash, right? When they set that thing up, they went ahead and they had debited the prepaid 18,500 credited cash, right? And then what? Then they went and counted, and the unexpired amounts were 6,000. Well, that's like the apples. I had 18,500 apples, and there's only 6,000 apples left, the amounts that haven't expired yet, right? What happens when your insurance premium expires? You got to buy more insurance, don't you? Okay, but right now they're going to have a little bit left over, so they won't have to buy any more. But we got to recognize that some has expired, hasn't it? So if there's supposed to be an ending balance in here of 6,000, and we're sitting here at 18,500, how do you get from 18,500 down to 6,000? You have to credit this 12,500, don't you? And when you credit it 12,500, it has the right balance in it now, so you would debit insurance expense and credit the prepaid. You debit the insurance expense because 12,500 of this has expired, hasn't it? Expired expense. Right? Okay. Okay, good. Let's take a look at this one now. This NWA. I think this is another rock band. This NWA has what? Has this $20,000. These are all 80s bands, I think. 90s or something. Maybe it's the 90s. The Meat Puppets were the 90s. I only remember them because their name. They were horrible. I don't think they were that. Anybody like the Meat Puppets? I don't think they were very good, but the name was good, huh? You like the Meat Puppets? Oh, okay. Okay, so we have what? We have this $20,000 that we signed on September 1st, and the note requires interest at an annual rate of 9%. The amount of interest to be accrued at the end of September. So what happens? We only have 1 month going on here. So we take the $20,000. What's the interest rate? How do we represent the interest rate? 0.09. 0.9 would be a disaster. Don't sign that note. 0.09 times what? Times 1/12, right? I mean, these are the kind of things you're going to be doing for the rest of your life, guys. I don't care if you're an accountant or not. You go to buy a new car, the guy's going to say, well, the interest rate, and you're going to say, hang on a minute, buddy. What did you say? And then you're going to write all that down, right? And you're going to say, well, heck, you're charging me 20% of that. How dare you? Right? These solar guys were going to come to my house and talk me into solar power. And I told my buddy, yeah, I got my present value calculations all ready for those guys to see what they want to charge me. And my friend started laughing. And I said, I'm not kidding, I really have the present value stuff. He says, that's why I'm laughing. I know, John, that you really have that stuff out there. Okay, so what happens? 20,000 times what? Times 9% times the 1/12. And again, for 1/12, you don't have to multiply by 1 and divide by 12. That'd be a little crazy. You can just get the 20,000 times 0.09 and then hit divide by 12. And do you get 150? You get 150? Okay. Okay, good. What if the problem said they wanted us to do this at December 31st? What if they wanted me to calculate the interest for the what? For the 4 months of December 31st? How'd you get that? Did you count on your fingers? Always count on your fingers for these questions, guys. All of September, all of October, all of November, all of December. It's really easy to say the 9th month to the 12th month is 3 months, and then you make a mistake, right? And the choices will always have that mistake in there for you, right? That's one of the choices. So if that's the case, it's 20,000 times what? Times 0.09 times how many months? Times 4/12 now. And so that's going to be what? Is that the, what's that? The 600? You see how they always like to give you the chance to misread a question and make the mistake? So that's 600? Okay, good. Question?
If it wasn't an annual rate, if it was monthly, or something like that.
If they told us a monthly rate, then we wouldn't have to multiply by the fraction of the year. And we would just do it for the month, right? Problems that we're going to get in this class, it's going to be, you know, I'll give you the annual rate. You just got to know to multiply it by the fraction of the year that's going on with it. But other classes, they might say monthly rate. If you take the finance class or something, they're probably going to get into some, get a little funky on this. Okay. How about the journal entry? Journal entry at September 30th. Do I owe this person interest now? If I don't, he'll see me in court. If I sit there and I tell him, I am paying you the 150, whatever it was, was it 150? If I don't pay him that one, let's say I call him tomorrow and say, hey, you know, I want out of this thing, 9%, you know, and I say, here, I call him on September 30th, and I say, here you go, take your money back. I don't want this interest anymore, and I give him whatever it was, 20,000 bucks. What's he going to say? Okay, where's the interest for the 1 month, pal? You borrowed the money for 1 month, didn't you? Interest runs with time. Okay, and so do I owe him this 150? So if I owe somebody money, what do you want me to do? Okay, well, what's the accounting entry you want me to make? Huh? Good, I have a liability. Excellent. I have to bill, right? I have to increase the liability. So you want me to debit it or credit it? What do you mean you don't know? Don't make me come back there. You have a liability. You got to credit it, man. Okay? Got to get that first slide. I'm telling you, that one slide's going to kill you if you don't know how to do it. Okay? And so what do you got to do? You got to credit what? Interest payable? For 150 and debit what? Interest expense. I've had an expense for that 1 month, haven't I? Even if I plan to pay the guy back to 20,000. I went to this store to buy some furniture, and I always ask them if they have the, 6 months no interest or 2 years no interest or something. And the guy says, oh yeah, we got it. I say, okay, I want that because I like to play with the store's money, right? Why not just go ahead and get what I want, keep the money, and then just pay them off. He says, now, if you miss the first payment, all the interest and everything is immediately due. And I'm thinking to myself, what do you think you're talking about? It's not due. Interest runs with time, doesn't it? What he meant is what? You're going to have to pay the balance at that point in time. If you miss that first payment, they won't give you the interest free anymore. Or you maybe have to make the payments, but it won't be the interest free. You'll have to pay the interest if you wait. But if you pay it off that day, then there's no interest, right? Okay. No. Because I realized that I get into arguments with people for no reason. Because at the end, he wouldn't know what I was talking about. Or maybe he meant what he was saying, and now I just made him mad, and now they're, gonna spit in my furniture or something. I don't know. So, okay. Okay, let's look at this one. Uncle Tupelo's gift signs a 3-month note to help finance increases in inventory for the Christmas shopping season. The note is signed on November 1st. in the amount of $75,000 and an annual interest rate of 12%. What is the adjusting entry to be made on December 31st? When did we borrow the money? November 1st, and they want me to give them the adjusting journal entry on December 31st. How many months? Good. Count on your fingers. When I was studying for the CPA exam, I'd be sitting there going, my dad would say, what, are you going to be a CPA that counts on your fingers? And I'm like, yes. For these kind of questions, I'm counting on my fingers so I get them until I know what I'm, forever. So I keep track of what I'm doing. So what happens? 75,000 is the amount we borrowed? Who wants to set this up for me? Times what? Times 0.12 times what? Good. Times 2/12. Excellent, guys. And put it in your calculator the way I said. 75,000 times 0.12 hit equals times 2 hit equals divided by 12 hit equals. Do you get 1,500? Okay. And when you get 1,500, again, just like we saw in the previous problem, debit interest expense, credit interest payable, right? Okay. Okay, good. Let's take a look at this one now. Yes, sir.
The option B was same thing, interest expense and note payable. The note payable is credited would start paying back.
Notes payable is for the principal.
Yeah,
They call that principal, right? You got principal and interest, right? You pay back the principal, then you would credit note payable. So let's say I don't pay any of this interest till this note is completely done. So I hold the note for 12 months. Okay. Did they say how long did they say the note was? Did he say how long it was? Okay, good. So we'll just make it for a year then. So I hold that note for 12 months. Okay. So how much interest am I going to owe the guy? You could do it by taking 75,000 times 12, or you could take 75,000 times what? Times 0.12 equals what? $9,000 interest for the full 12 months of that note. We're just playing with this, guys, and assuming it's a 12 months. Okay? So what's going to happen? When I go to pay the guy back, I'm going to debit interest expense, and I had already set up, actually, let's do it this way. It's 9,000 total, but let's do it this way. 75, let's say I pay the guy in, when do I sign the note? I signed the note November 1st, so I'm going to pay him back October 31st of the next year, right? I'm into the next year now. So I put up my interest payable at December 31st, but now I'm going to pay the guy back, and I'm going to pay him on October 31st of the next year. So I'm going to take 75,000 times what? Times 0.12 times, I'm paying him what? October 31st. So I've got what? I've got 10 months now, don't I? All of January, all of February, all of March, all of April, all of May, June, July, August, September, 10 months, right? October 31st I pay him. So I multiply that times what? Times 10/12. That gives me what? 75,000 times 0.12 times 10 divided by 12 gives me what? 7,500. Okay. Is that right? Do I have a second on that? Okay. 7,500? It's 7,500? Okay. So I'm going to go ahead with this 7,500 now, and I'm going to do what? I'm going to debit interest expense, 7,500. Debit interest payable for the 1,500 that I had set up at December 31st of the last year. Right? Well, I asked if it was a full 12 months, and you guys said no. You said it was. Now you're going to point out to me that it's 3 months. Where were you 15 minutes ago when I asked how many months it is? So it's a 12-month note now. Because I just asked you 2 minutes ago, how long is this note? And you didn't say anything. Now you're going to point out to me that it's 3 months. Okay, so it's a 12-month note. Okay. So just assume it's 12 months. So I'm going to debit interest expense $7,500, credit interest payable. Debit interest payable for the $1,500. That was for the what? The 2 months, October, November, right? And then what? I'm paying the guy his interest, right? The total interest was $9,000. I'm paying him the interest where I had taken the expense $1,500, taken the expense for that the year before. And now I'm simply paying him back his interest back. Do I have to pay him anything else back? I have to pay the principal. So I'm going to debit note payable. See how great this class is? They're trying to bust into it. I debit the note payable for $75,000 because I'm paying the guy back now, right? Right? And then I'm going to go ahead and I'm going to credit cash. How much cash am I paying him now? What's that? $84,500 or something like that? How much cash am I paying him? What is 75,000 plus 75 plus 9,000? 84,500, right? I'm paying him back his principal and his interest, right? The note payable got set up at the time I borrowed the money back in November. I would have debited the cash, $75,000, and credited the note payable for $75,000 because I just sat there and I borrowed. This is when I borrowed the money from him, November 1st, and I didn't know it was a 3-month note. Thank you for pointing that out to me, although late. You did need to make that point. So it was a what? It was a 3-month note, but I just turned it into a 12-month note. So what happens? November, December goes by, end of the year comes, I accrue the interest for those 2 months, don't I? Then what? I show that as interest payable, my December 31st balance sheet. Then we go into the new year, don't we? And in the new year, I finally go ahead and I pay the guy on October 31st. When I pay him, I take the interest now for the 10 months, October through January through October 31st, the 10 months, take the interest expense for that, pay him back his interest, including the interest I accrued at the end of last year, and pay him back his principal, right? Yes, sir.
Credit for cash, account 84,500.
Mm-hmm.
How can the 9,000 plus the 75,000?
Oh, I don't know. Guys, I was asking you when I'm writing the number. I say, what is it? And everybody just stares there and looks at the number. And then after I write the wrong number, everybody says, well, that's the wrong number. So tell me the number and I'll write the right one. I'm going to see.
Would you add up all the debits and start between 7,500?
Yes, sir. Debits equal credits. Debits equal credits, and I just take the total of what I'm paying him. I'm paying him back the interest payable that I had set up. I'm paying the interest expense for the 10 months. I'm paying him back his principal. That's got to equal the cash, 84,000. Yeah. Debits equal credits. If I write down a journal entry and the debits don't equal the credits, you're supposed to tell me. The debits don't equal the credits. No, they're not. Interest expense is an expense. Interest payable is a liability. Interest expense is an expense. Interest payable is a liability. Interest expense shows up on the income statement. Interest payable shows up on the balance sheet. They are not the same thing. They are two different accounts. One recognizes that I have a bill, a liability to pay. One recognizes that I have incurred an expense. Time has expired and I owe the person that money, so I show that as an expense. I don't know what you want me to tell you if you ask me that two different accounts are the same thing. That's to me like saying, green is actually purple, right? No, it's not. If I pay part of the principal off early, then I'm going to only accrue interest on a portion of what I owe. That's right, the remaining portion of what I owe. That's correct. So if I went ahead and say I paid the guy principal at December 31st, let's say I went ahead and I paid him, the deal was that I had to pay him principal and some principal and interest at the end of each year, let's say. So I go ahead and I'm going to now at 12/31 still debit interest expense. Let's see, where do I want to write this? I can erase this stuff over here, right? Just to give myself more room. Theoretically, I can erase it. Whether or not the thing will allow me to erase it is a whole nother problem. I don't know why it has so much trouble accepting the eraser. It was working fine before, and now all of a sudden it wants to fight me on the eraser. Oh, well, I'll put it on the board. Okay. So locks up on the eraser. Okay. So let's say that I have this $75,000 and I did my interest on it. We've already calculated was what, $1,500? So I'd go ahead and I'd debit interest expense for $1,500, and then he's also saying that he wants me to pay him, say, how much? You want to make it $5,000 on this? Okay, and so I'm going to go ahead and I'm going to debit now note payable, $5,000, and I'm going to go ahead and credit cash now for $6,500 because now we're assuming that I'm going ahead and paying some of that interest. Okay, so now I owe the guy what? $70,000, and the deal is that I'm going to pay him off on October 31st, right? Yeah. So I take the $70,000, I would multiply that times, what is it, 10? What's the interest rate? 12.12 times now 10/12. So now my interest is what? For those 10 months. $7,000, you say? 7,500?
No, 7,000.
Okay, so what am I going to do? I'm going to go ahead and I'm going to debit when I pay the guy, debit interest expense now only $7,000. This is for now the what? The 10 months that have gone by. I'm going to debit note payable for $70,000 because I only owe him $70,000 now, right? Because I already paid down $5,000 of it, and I'll credit cash for $77,000. That is going to equal the credit. I'll pay him for $77,000 because I'm paying him off now, right? Okay. Now that's sort of a very basic way of doing this. We actually would probably amortize this loan in a more sophisticated manner, but we probably won't get into that much in this class with loans and payables and that kind of thing. But there is that process. Okay, I'm going to close this and reopen it since it's giving me a hard time. I'm thinking if I do that, that'll bring everything back. So let's just do it that way. Okay. Okay, so let's come back down. What is the problem? You think I was trying to send a satellite? Trying to keep the satellite from crashing or something. Okay. All right, let's take a look at this one then. We were on number 8. Okay. Okay, good. So let's take a look at this one, and we say that we have unexpired amounts of insurance before adjustments of $15,200. So we must have bought some insurance. So what did we debit when we buy insurance? What do we debit when we purchase insurance? Prepaid insurance. It's an asset. For how much? $15,500. Credit cash. For $15,500. And so if we teed up prepaid insurance, is this the only class where they don't have a podium? I feel like I got my face planted into this thing. Prepaid insurance, they debit that $15,500, and that gives us a balance here of $15,500, right? With me so far? Okay. And then they count up and they see that there is what? Unexpired amounts of $6,000. So that means the balance in here should be $6,000, right? So if I'm $6,000 that's left in there, some amount has expired, hasn't it? How much has expired? $9,500. It's the same thing again. You had 15,500 apples. You ate 9,500. You're left with 6,000, right? You count that you have 6,000 left. You must have ate 9,500, right? Although here it's insurance expiring. So what do? You debit the expense. It has expired. You credit the prepaid insurance. We've seen that like 52 times now, haven't we? Okay. If you're getting bored, get used to it. You want to be a business major. If you want excitement, go take art history or something, right? Okay? All right. So you come over and you take a look at this one, and we say December 31st, 2013, before year-end adjustments, Murmur Company's insurance expense account had a balance of $1,450, and its prepaid insurance account had a balance of $3,800. It is determined that $2,800 of the insurance had expired. So what do you want to do with this? $2,800 is expired. What do you want to do with it? The insurance expense account had how much? Insurance expense was sitting here showing $1,450, wasn't it? The insurance expense? Okay. And then what? Then they looked at, and they had a prepaid insurance. Different accounts, right? One's the expense, the other is the asset, prepaid insurance. They are not the same thing, right? So I have this prepaid insurance sitting here, and the prepaid insurance is how much? $3,800. So I have a balance of $3,800 sitting here. And then they sat there and they determined that $2,800 had expired. Well, if $2,800 had expired, that means I should have done what? Reduce this asset for the amount that expired, shouldn't I? Shouldn't I credit that to bring it down to $1,000? This balance is now $1,000 because $2,800 expired. And since $2,800 expired, I have to debit insurance expense $2,800 over here, don't I? So the total insurance expense would be this $4,250, right? Right? We had $1,450 sitting there. We took another $2,800 for the amount that expired, right? Expense expired. Okay. So the only difference between that and the last one was what? There was already an amount sitting in the insurance expense account, right? And we just added on to it. Other than that, it was exactly the same. Now you come down and I say, using the same facts from the previous question, what is the balance in the prepaid insurance account? Well, we already figured that out, didn't we? It's $1,000. Okay. The balance in the prepaid rate account before adjustment at the end of the year is $18,000, which represents 3 months of rent paid on December 31st. So at December 31st, the guy says, hey, you got to pay me the rent for 3 months because you had a pretty wild party here and I want to make sure that I'm getting paid up, right? And that's your punishment. So when I pay the guy, I'm going to debit what? Is there a question, guys? No? I'm going to debit the prepaid, what, $18,000? At the time that I pay the guy in credit cash? For $18,000 when I pay him. Okay? And so I have now, what, $18,000 in the prepaid account, don't I? And that represents how many months? 3 months. So if I pay him $18,000, and that represents 3 months, I divide that by the 3 months. Doesn't that give me $6,000 of expense per month? So on December 31st, I have 1 month that's gone by. I debit the rent expense, I credit the prepaid, right? And I could ask you, what's the balance in the prepaid account? Maybe I give you this same question on the test, and then I just simply come out with, instead of asking you, you know, what's the expense or what's the journal entry, I say, what's the amount that's sitting then in the prepaid account after all this? It's going to be the $12,000. It's going to be the $18,000 that I had just debited there. There's the $18,000. And then I just credited it what? $6,000. That means there's $12,000 left, right? I'm showing the whole world that I've got 2 months left on this at what? $6,000 a month? That's a pretty steep rent. Must be quite a place. Okay? Okay, good. Let's take a look at, how much, what do we have, 3 minutes left? Oh, 5 minutes? What's your clock show? 3 minutes? Okay, I'll tell you what. Starting with number 12, when we reconvene on Wednesday, you're on. You're the entertainer. I'm going to go ahead and I'm going to help you along with questions, but I'm going to be calling you up to go through starting with 12. Hang on, guys. Starting with 12 and working into the practice midterm that's posted up there. I'll put another one up. We'll do this again on Monday. by Wednesday next week, you should be the king and queen of this stuff, right? Okay, guys. All right. Have a good rest of the day. I will see you on Wednesday.
Did you already record going to this another class?
I did not. I just recorded. Yeah.
Oh, I'm used to you wearing your headset.
I forgot it today, so maybe a little echoey. But
And then,
let me in fact do this
are
right
you
now.
personally